Welcome back to another market update. It's been a few weeks since the last update, so let's talk about some of the things that are going on. One thing that's for sure, the usual suspects we've been talking about all year, inflation, the Fed, rising rates, the Russia-Ukraine war, and the associated market volatility are all still front and center. But are we starting to think the tide is shifting?
Maybe. This isn't the first time this year we've heard that inflation may be cracking. So we share this with a cautiously optimistic view. If it's true, inflation may soon start to wane. There are worse places to start than with the price of crude oil. You see a pretty swift drop, almost back down to $100 a barrel. And copper, often referred to as Dr. Copper, because of its ability to identify the economic cycle. Should prices continue trending lower, this in itself would go a long way to reducing headline inflation.
Next up, rents. Rents are the #1 contributor to core inflation. We see here if the relationship between prices on apartment list and rent CPI holds up, the huge rent component of CPI looks like it might also come down.
Something else we've been looking at all year, used car prices. Here we're looking at used car prices and their contribution to the headline inflation number since 2020. On the left in gray is used car prices, the percentage change from prior year. So for example, the peak of 50% right here in the middle of last year represents used car prices 50% higher than the year before. So even though used car prices aren't going down yet, they've certainly stopped going up and aren't contributing to CPI inflation nearly as much as we see here in blue.
Airfares. Has anyone booked a flight in the last 3 months? 2018 through 2021 all appear more or less flat. Look at 2022 in purple. Ouch. Airfares have been a huge contributor to CPI inflation. While we're not out of the woods yet, especially with oil and gas prices so high, it does appear to be rolling over.
What's not rolling over? This is not oil, it's not inflation, or even a cryptocurrency. It's the average monthly mortgage payment in America, up 50%. Yikes.
Add that to this. This year has brought the largest destruction of wealth in modern history. Close to 16 trillion with a T has evaporated from stocks and bonds this year. That doesn't even include the crypto implosion, which would likely add another couple trillion. As we've said so many times this year, 2022 has truly been a historic year.
Indeed. Adding a little more color to that, one of the most unique but most challenging parts of this year is the behavior of bonds that haven't acted as the equity diversifier we hired them for, but instead have also drawn down this year. This is remarkable. The broad bond index, its best year was positive 32% in 1982. Its worst year before this year was 1994 with a minus 2.92% return. This is why we buy bonds, for these types of returns. We can handle a portion of the portfolio being down 2.92%. But this year, that same index has drawn down over 12%.
So where does that leave us looking ahead? Well, pretty much everybody and their mother is forecasting a recession on the horizon. It goes without saying that recessions are not good for the market. Seeing as how things like the job market are still super strong, look at how low unemployment claims continue to be, and corporate earnings estimates haven't come down yet. We're in a strange sort of purgatory type environment where everyone's sure the Fed is going to tighten and tip us into recession, the hard landing you might be hearing about on the news, but we're not there yet. And things are still pretty good.
Exactly. Then we have personal savings rate, now lower than pre-COVID lows, and credit cards getting to an all-time high. This just as the number of stories on the data service Bloomberg regarding job cuts, firings, and layoffs is starting to pick up steam.
All right, plenty of clouds on the horizon. Is there any good news out there? Sure there is. As we mentioned, when markets draw down, even though it's uncomfortable in the present, it makes forward returns much higher. So from this point, future returns in the stock market are much higher than they were 6 months ago. And number two, the stock market is a much, much better value than it was 6 months ago. Stock valuations have come down a lot, and the market has gotten much cheaper.
And taking a quick look at bad starts to the year, we see this year has been among the 6 worst starts since 1928. But the good news is that the returns the rest of the year have been pretty decent. And looking at bad quarters, like we just had where the S&P 500 is down more than 15% in a single quarter, again, as Chad just mentioned, forward or future returns are a lot better.
Bottom line is, it's not easy, but let's keep our heads down and stay focused on the long term, and we'll all get through this together. We look forward to bringing you our halftime show next week, and thank you very much and have a great day.